Good afternoon, everyone, and welcome to this ESRC Festival of Social Sciences event. My name is Heidi Karjalainen. I am a research economist here at the IFS. And on behalf of the IFS, we're very excited to be part of this festival, and we're also very grateful to the Economic and Social Research Council, both for much of the funding that they provide to the IFS, as well as, of course, organizing this event. This is the last presentation in a series of presentations that researchers at the IFS have been putting together and presenting as a part of this festival. There are a number of really interesting presentations that my colleagues have given this year, and you can find recordings of all of them on our website. And a recording of this presentation will also be available afterwards. So today we have IFS research economist Isaac Deleste talking about corporation tax in the international context and how we should think about taxing multinational companies. Isaac will be speaking for about 40 minutes or so, and then we'll move into Q&A afterwards. If you have any questions, please do post them on Slido. You can post questions, your own questions on Slido, and you can also vote for other people's questions. So the most popular questions will then move up to the top of the panel. So please do vote for the ones that you find most interesting. So it's easy for me to then pick the ones that people want to hear the answers to the most. But that's it for me for now until the Q&A. So I'm just going to hand over to Isaac right now.
Yeah, thank you very much, Heidi. As Heidi said, I'm going to be talking to you a little bit today about corporation tax, and specifically the question I'm going to be asking is, what are the specific challenges that face policymakers trying to implement corporation taxes and trying to tax corporate profits in a highly globalized world and a world where capital is highly mobile? So broadly speaking, today's lecture is going to be in three parts. I'm going to start off just by talking a little bit about what a corporation tax is, just on a very basic level, and how it operates in the UK. Secondly, I'm going to start thinking a little bit about who bears the burden of corporation tax ultimately. And specifically, we're going to be thinking about whether we should expect the owners of capital, so shareholders, to be worse off as a result of imposing corporation taxes, or whether actually maybe we should be expecting the firm's workers, or indeed other groups associated with the firm, to be worse off as a result of corporation taxes. And finally, the question I'm going to be coming to is, what are the particular problems that arise when we're trying to impose corporation taxes on multinational corporations? So these are corporations based in lots of different jurisdictions all over the world. And particularly, I'm going to be addressing some of the stories that I'm sure members of this audience will have seen in the press, where ostensibly very profitable multinational companies appear to pay very little tax in some jurisdictions. So that's broadly the picture of where we're going to be going in the lecture. So first things first, what is a corporation tax? Well, on a very basic level, a corporation tax is a tax on the profits of incorporated businesses. What are incorporated businesses? Well, broadly speaking, these are the class of businesses that benefit from limited liability. So limited liability means that if they go bust, the shareholders of these companies aren't on the hook for any debts that the company may have had. So broadly speaking, how does a company work? Well, clearly revenue flows into the company or the firm from the firm's customers and the sales that it makes to those customers. There are also going to be costs that are going to flow out of a company. They're going to go, some of those costs are going to go to pay the firm's suppliers for intermediate inputs. So things like raw materials. If we've got a steel widget maker, then our steel widget maker needs to buy raw steel to make its widgets. That's going to be one set of costs. And then the other big set of costs is going to be the firm's wage bill. And those wages are going to flow out of the firm to the firm's workers. Now, once you take that revenue and you subtract the costs, what you've got left are going to be the firm's profits. Now, it's worth just saying that there's a whole nother lecture that I could give here about the role of investment in the corporate tax system. We're going to be ignoring that for today's lecture, just because I haven't got time to cover that very interesting topic in the fullness that it would deserve. So we're just going to be thinking today about a firm where the profits literally are revenue minus cost. There's no investment behavior going on. And it's this stream of profits ultimately that the corporation tax is levied upon. So this is what is actually being taxed when we think about a corporation tax. And once the corporation tax liability has been subtracted from profits, well, the residual is going to be the dividend that can then be paid out to the firm's shareholders. So that's the very basic setup of how we might imagine a firm to generally operate and how corporation tax interacts with that. Now, one point I just want to bring up now, although we're going to come back to it later, is it's very important to understand that while this is legally where corporation tax is being levied, so if you look at the statute book, it's profits that are subject to corporation tax. It doesn't necessarily mean that it's going to be the firm's shareholders who end up ultimately worse off as a result of this tax. So we're going to see that the ultimate economic logic of these taxes isn't quite so straightforward. Okay, so we know broadly what a corporation tax is. How much money does it raise? Well, in 2020-21 in the UK, and this is a year before the interference that we see in a lot of the figures as a result of the COVID pandemic, the corporation tax raised about £45 billion. Now, clearly that's not small change. It's a great deal of money, but it isn't quite as much as the really big three taxes in the UK, which are income tax, national insurance contributions, and VAT. So corporation tax is the fourth biggest tax in the UK, but it's considerably smaller than those big three. So just to give you a sense of scale, income tax raises about 4 times as much money as corporation tax does. Okay, so how has that changed over time? Well, on this chart on the horizontal axis, I'm going to be showing you financial years going back to roughly the mid-70s. And then on the vertical axis, I'm going to be showing you the main rate of corporation tax levied at different points in time. Now, in the UK, what you can see is that there has been a very, very large decline in corporation tax rates over this period. And that occurred in 2 big flurries of corporation tax cutting, the first under Margaret Thatcher's government in the mid-1980s, and the second under the Liberal Democrat and Conservative governments that we've had since 2010. So we've seen the rate go down enormously, really, from above 50% in the mid-1970s to just 19% today. Now, this isn't something that's isolated to the UK. If I show you on this same slide the main rate of corporation tax in the United States, also that in Germany, and I could show you a whole other host of developed economies here, it's very clear that internationally there has been a pattern of a secular decline in corporation tax rates all around the world. So it's certainly not a UK-specific story. Okay, so we know what's happened to the rate over this period. What about the revenue? So again, on the horizontal axis, we've got years going back this time to the late 1960s. But on the vertical axis now, we're going to have corporation tax revenue as a share of GDP so that it's comparable across time. A couple of things that I'd like you to just sort of notice about this chart. The first is that corporation tax revenue really bounces around quite a lot. It's highly pro-cyclical. What I mean by that is that in the boom times, when the economy is doing well and profits are high, you get a lot of revenue from corporation tax. During recessions, which I've marked on this chart, profits tend to go down and you tend to get a lot less revenue through corporation tax. The second thing to notice here is that it might seem quite surprising that I just showed you a chart where the rate of corporation tax has fallen quite drastically over the last 50 years or so. And yet on this chart, what we can see is that the revenue from corporation tax doesn't seem to have undergone a similar decline. I mean, it's bounced around quite a lot, but broadly speaking, it's been pretty stable in terms of the level. There's no clear upward or downward trend, at least since the sort of the early 90s or late 1980s. Why is that? Well, it isn't because, as some politicians have claimed, that corporation tax cuts always pay for themselves. In fact, it's because over this period, successive governments have undertaken a strategy not only of reducing the rate of corporation tax, but also broadening the base by making investment allowances less and less generous. So while a lower rate is in place, it's being applied to a wider base, which means that corporation tax receipts haven't fallen as much as you might expect just looking at trends in the rate. Okay, so we've got a broad idea now of what a corporation tax is, how much money it brings in, and how that's changed over time. So what I want to do now is really get into the meat of this lecture, which is to start talking about the challenges posed to this kind of tax when we start thinking about it in an international context. And the first of those challenges is going to be that what we're going to see is that in a world where capital investment is highly internationally mobile, while workers are less internationally mobile, there's going to be a risk that more and more of the burden of this tax is ultimately going to fall on workers rather than shareholders. Secondly, what we're going to see is that for multinational companies, so companies based in many different jurisdictions, the way in which we've set up corporation taxes as an international community is going to leave lots of opportunities for these kinds of companies to engage in tax avoidance and to make it difficult for national governments to levy tax on their profits. Okay, so let's start with the first of those two questions, which is who is ultimately going to be bearing the burden of corporation tax. Now, the first thing I want to say on this topic is that all tax ultimately is borne by people. Now, that might sound like a really obvious thing to say, but I think it's easy to imagine when we think about corporation tax that what's being taxed is some kind of anonymous, amorphous legal entity called the corporation, and no real people are really ending up worse off as a result of this tax. But the truth is that as economists and as policymakers, we don't care about the welfare of corporations. Corporations aren't people, they're legal entities. What we care about is how this tax ultimately is going to affect the various groups of people associated with a corporation. And so what we want to know is that, yes, okay, all tax is ultimately paid by people. And the question is going to be which people, which of the various groups of people associated with a corporation, its customers, its shareholders, its workers, which of those groups is going to end up worse off as a result of corporation taxes? And that's going to be relevant for answering a whole range of different questions, including questions around inequality. Now, it's worth mentioning that shareholders of corporations aren't all sort of Elon Musk's and Jeff Bezos's of the world. They're not all oligarchs. Anyone that has a private pension in the UK, that pension is almost certainly invested in corporate stocks. And so they are shareholders, so that the class of people who are shareholders in the UK is broader than people generally tend to think. But nevertheless, it is the case that workers on average are less well off than shareholders. And so if we had reason to believe that corporation taxes predominantly fell on workers, then that might have different implications for inequality than if they predominantly fell on shareholders. Okay, so before we really get into the meat of the international question, I just want to take a step back and go back to our diagram here of the firm, of a company, and ask sort of a bigger picture question, which is that if ultimately it's people who pay corporation tax, then why do we actually have a corporation tax at all? And the reason I ask that is, well, wages that flow out of firms to the firm's workers and dividends that flow out of firms to the firm's shareholders are already both subject to the income tax in the UK. We already tax those streams of income as they leave the company. And the question that raises is, why do we also need to tax profits at the firm level if we're already taxing dividends through at the individual level through the income tax? Now, the answer you'll often hear to that question is that what the corporation tax allows you to do is to levy tax on foreign owners of companies. So if someone owns part of a company in the UK, we obviously can't levy income tax on the dividends they receive, because those dividends are going overseas. And so one way to capture some of the profit they're making from a firm based in the UK is to tax the profits at the firm level, given that the firm is based in this jurisdiction. But is it actually foreign shareholders that we would expect to bear the burden of this tax? Well, that's the question we're going to be looking at in a little bit more detail in this section of the lecture. So I'm going to be doing this through a slightly more formal approach. Don't worry, I'm not going to be doing any algebra or anything like that, but I just want to give you sort of a very simple model for how we might start thinking about this question of who ultimately ends up worse off as a result of corporation tax. So we're going to have a small open economy here, which is going to be the UK. And there's going to be a prevailing rate of return to capital in the UK. So you can think of this as the returns that investors are getting from their investments in companies, and it's going to be 3%. And what you can see in these little molecules that I've got on the screen are little units of production. You could think of those as companies or anything else, and they're made up of little K's, which are capital, and little L's, which are labor. So you've got workers and you've got capital, such as machinery, and together those are creating economic activity and output in the UK. So again, a very simple setup, but hopefully a way to help you think about how these taxes might operate in the real world. So let's imagine we have our little model economy here, and we impose a corporation tax on it. Well, in the short run, everything is fixed, and basically the owners of capital have to swallow a lower return. So I've got my money invested in a company. I now have to pay corporation tax on the profits made by that company, and so I make less money on my investment. So let's say as a result of the corporation tax, the rate of return falls to 2.5% in this economy. Well, that's all very well, but now we need to start thinking about the international context. Let's imagine, for instance, that the prevailing rate of return in the United States is still 3%. Well, in this case, you can see that people who are invested in the UK have a very, very clear incentive. Why should they swallow a measly 2.5% on their investments when they could be getting 3% over in the US? And so what you'd expect to happen is that investors are going to start moving their investments from the UK to the US, where they can earn a higher return. And they're going to do that until capital becomes, an investment becomes more and more scarce in the UK. And just like anything else, the laws of supply and demand apply to investment and to capital. And what they're going to mean is that as the supply of capital dwindles, the price is going to go up, and the return that capitalists, that the owners of capital are going to receive, is going to go back up to 3%. Now, once it reaches 3%, investors no longer face an incentive to move their investments from the UK to the US. We're back in a stable position. But it's worth just taking stock now of what's happened in the long run as a result of imposing this tax. Well, for the owners of capital, for shareholders, ultimately nothing's changed. They were earning a 3% return on their investments before the tax was imposed, and now they're earning 3% after the tax was imposed. The only difference really is they're earning it in a different country, but that's not really a big problem for them. Capital is very mobile internationally. It's not difficult for me to invest in a US company instead of a UK company. But what about the UK? Well, what's happened in the UK is that there's now less investment, less capital than there was before the tax was imposed. And what that's going to mean is that UK firms aren't going to have the most up-to-date technology. They're not going to have the most cutting-edge machinery. And the result is that the wages of UK workers, pardon me, are going to grow less slowly, or may even fall. And ultimately, it's going to be the workers who bear the full burden of this tax as a result of now working in firms that don't have the most up-to-date technology available. Essentially, workers are going to be working in a less efficient economy as a result of this tax. Now, it's worth noting that these some quite extreme assumptions. We're assuming that capital moves absolutely perfectly internationally and that labor can't move at all. And it's as a result of those assumptions that we get this quite extreme result that only capital bears the burden of the tax and labor bears none of the burden of the tax. And in reality, we wouldn't expect to find quite such an extreme scenario, and there are several reasons for that. Firstly, it may well be that there are certain investments, certain kinds of businesses that can only operate in a specific location. So we might think about, for instance, companies drilling for oil in the North Sea. You can't just go and move those operations to another country easily. They have to remain in the UK, and so that capital actually isn't particularly mobile internationally. And you might think of other examples of that as well. So there might be particular benefits to investing in the City of London, for instance, because there may be agglomeration benefits to banks being based there, and that it's not easy for them to go and earn the same profits in a different location. So again, you might have a similar effect there. So we certainly wouldn't expect to see this very extreme result of 100% of the burden of the tax falling on workers rather than shareholders. And another point just to make here is that while the amount of capital is going down per worker, so the amount of investment per worker is reducing, and so the wages of the workers we'd expect to go down too, labor isn't the only fixed factor here. We could also think of land, for instance. So the amount of investment, the amount of capital per square mile of the UK is also going to fall. And that's going to mean that landowners can expect to get lower rents as a result of this corporation tax too. So workers aren't the only group who would expect to be worse off as a result of this tax. Broadly speaking, however, our expectation should be that Labour will at least bear some portion of the corporation tax, and that the more mobile capital is, the larger portion of the tax is going to be borne by workers. Now, we've seen the sort of the theoretical setup there. What does the empirical evidence say? So what have people actually found when they've tried to measure this in the real world? Well, it's worth saying that this is quite a difficult thing to measure in practice, but people have had a go. There's one very good paper by Suarez, Serrato and Zaidar, which finds that about a third of the burden of corporation tax falls on labor in the US setting. So they use differences in corporate tax rates in different US states to estimate this. There's also been studies in Europe. So this paper looks at variation in local business taxes in different German municipalities, and it finds that about 50% of the burden of corporation tax ultimately falls on labor. It's worth saying that there's no reason these numbers should necessarily be the same. We might expect that more open economies, like European economies like the UK and Germany, we might see a larger share of the burden of tax fall on labor than you would in a larger economy like the United States. But it's also worth noting that even within the same country, these estimates do vary quite a lot in the empirical literature. So it is quite hard to estimate this stuff, and it's hard to say with any high degree of confidence that exactly X% of the burden of corporation tax falls on workers or on shareholders. But there does seem to be a general agreement in the empirical literature that at least a decent proportion of corporation tax is ultimately being borne by workers rather than shareholders. We certainly shouldn't think of this as a tax that exclusively falls on shareholders in the way that we might if we only looked at the way in which the tax is legally prescribed. Okay, so now we've covered what a corporation tax is, how it's changed over time, and we've also covered some of the particular challenges associated with the fact that in where capital is highly mobile, we might expect a greater share of the burden of corporation tax to fall on workers. In the final part of this lecture, I want to talk about multinational corporations, corporations based in many different jurisdictions, and the particular challenges associated with taxing these kinds of companies. So the basic problem we face when we have a multinational corporation is an allocation problem. So imagine we've got a company here that's based in 3 different jurisdictions. It's got subsidiaries in lots of different countries. And just to give a very simplified example, we're going to imagine this company is completely owned by and financed by shareholders based in the UK. And in the jargon of this kind of stuff, that's going to be known as the residence country. Next, we're going to imagine that our international corporation does all its manufacturing, does all its value-added activity in a second country, the source country, in this case, Germany. And then we're going to imagine that it sells all its products in a third country, in this case, France, and that's going to be known as the destination country. Now, I think the point I want to impress upon you here is that these three countries face a challenge in trying to decide how much of this multinational company's profits each country gets to tax. And I hope what you'll start to see is that this is really not a very straightforward question to ask. And the reason for that is that we could imagine a scenario, of course, this is a simplified example, but we can imagine a scenario where this company could make no profit at all if it weren't for the financing it gets from the residence country. Equally, we could imagine that it would make no profit at all if it weren't able to create its product in the source country. Maybe it could only manufacture its product in that country because of, I don't know, the expertise that exists in that country. Equally, we could imagine that this company might make no profit at all, that 100% of its profits might be dependent on selling its product to people in the destination country. Maybe only French people like this product. But if 100% of the company's profits are dependent on all 3 of these countries, not all 3 of these countries can tax 100% of its profits. It's not going to have enough profits to go around. And so working out what share of the company profits goes to each country is really not an easy thing to work out. It's not a trivial problem at all. Now, the way in which the international community has confronted this issue is through something known as the 1920s Compromise. Now, this is an international agreement that was brokered by the League of Nations, which is the interwar predecessor of the United Nations. And what this international agreement says is that it introduces the principle of taxation at source. And what that means is that when it comes to corporation tax, it's the country where the value-added activity takes place. So in our previous example, that was Germany, the country where the manufacturing was taking place. It's that country that has the right to tax profits. Okay, so to make that a bit more tangible, I want to take you through a sort of a simplified example. So let's imagine we have a French car manufacturer, in this case, Renault, and let's say it wants to sell its cars in the UK, and to start off with, it wants to do that by selling the cars to a separate company, a UK-based car dealership that's then going to sell those cars to UK customers. Well, how is this going to work? Well, the cars are obviously going to be exported from France to the UK. The UK car dealership is then going to pay for those cars. It's going to pay the wholesale price of those cars. And what you can see is that in this scenario, the value added is automatically going to flow back to the source country, to France. So the value associated with those cars is their price. The money associated with that price has flowed from the UK to France, and now it can be taxed as part of Renault France's profits by the French authorities. Everything's working fine. Now, where this becomes a little bit more complicated is if our French car manufacturer now wants to sell its cars in the UK, not through a separate company, but through a subsidiary. So Renault France sets up a subsidiary, Renault UK, and what it does is it exports its cars, as in the previous example, from France to the UK. But I hope what you can see is that under this example now, there's no obvious reason why Renault UK should pay Renault France for these cars. After all, these are the same company. And so what the taxation at source system requires is that Renault UK in this situation will need to make what's known as a transfer payment to Renault France. And what that means is it essentially needs to pay Renault France for those cars as if these were two separate companies. And importantly, that payment is governed by a principle of international law called the arm's length principle. What that means is that Renault UK needs to pay a fair market price for those cars. And you can see that in this case, that's not going to be a particularly difficult thing to police. We can see the price, the wholesale price of cars on the international market. We know, broadly speaking, what a fair price for these cars should be. We can make sure that Renault UK is making the appropriate transfer payment to Renault France so that Renault France's profits can be calculated in France and taxed by the French government. Great, but if taxation at source works so well, if it works so smoothly, then why is it we see headlines like this in the press? Why is it that we again and again seem to see stories about ostensibly highly profitable corporations that in some jurisdictions seem to pay very little tax? Well, in order to try and understand better why this might happen, I want to take you through the example of a cup of Starbucks coffee that is sold here in a UK Starbucks to a UK customer. And in line with the international taxation principle of taxation at source, the question we're going to be asking here is, where is the value created for this cup of Starbucks coffee? Okay, so let's start at the beginning. Let's imagine that the coffee beans for this cup of coffee are farmed in a Starbucks-owned coffee bean plantation in Rwanda. Now let's imagine those coffee beans are exported to another Starbucks subsidiary in Switzerland. Well, in this case, we can imagine the transfer payment is going to be very simple to work out. Coffee beans are a readily traded international commodity, so it's pretty easy to know what a fair price for them is, and we can make sure that the right price is paid by Starbucks Switzerland to Starbucks Rwanda, where the Starbucks Rwanda can then tax those profits as it sees fit. Next, Starbucks Switzerland is going to export those coffee beans to Starbucks UK, where they can then be used to make this cup of coffee for UK customers. And again, we can imagine that the transfer pricing in this situation is going to be quite easy to work out. Presumably roasted and prepared coffee beans are something that are readily traded between companies, and we can work out what a fair price for them might be. And if this was the end of the story, then taxation at source would be working quite smoothly. We'd work out the total revenue that Starbucks had made in the UK from selling its coffee. We'd subtract all its costs, including the cost of importing coffee from Starbucks Switzerland, and the resulting profits could be taxed by the UK government. The problem here is that we've missed one of the crucial components of what gives a cup of Starbucks coffee its value. And that is the Starbucks brand. Now, let's imagine that just as if these were two separate companies, the intellectual property for the Starbucks brand is held by another Starbucks subsidiary, this time based in the Netherlands. Now, again, just as if these were two separate companies, Starbucks UK is going to make a royalty payment to Starbucks Netherlands for the right to use the Starbucks brand. Now, the difficult question here is, how much should Starbucks UK pay Starbucks Netherlands for the right to use that brand? And I hope what you can see is that that's really not an easy question to answer. The Starbucks brand is an asset owned by just one company, and it's never sold. This isn't like coffee beans. It's not a readily traded international commodity. And so it's very, very difficult to know what an appropriate price for the Starbucks brand would be. And when so I think the truth is that in situations like these, particularly where we're talking about intangible assets like intellectual property, there's often really no right answer, or at least no easily discoverable answer, to the question of where is value being created. And when you start asking these inherently ambiguous questions through the tax system, I don't think that we should be surprised that international corporations end up choosing the answers to these questions that reduce their tax liability. How do they do that in practice? Well, let me just take you through a brief example, following on from what we were talking about before with Starbucks. Imagine that the UK is a high tax country in terms of its corporation tax, and that Starbucks is a low tax. The Netherlands is a low tax country. What Starbucks will do in this case is that it's going to make its royalty payment to the Netherlands for the right to use the Starbucks intellectual property, but it's going to have an incentive to make that payment as large as possible, to value the Starbucks intellectual property as highly as possible. As we discussed before, that's very hard for authorities to police. It's very hard for authorities to tell Starbucks that they're paying too much. And what that's going to allow Starbucks to do, it's going to allow them to run up lots of costs in the UK and so reduce their profit in that country, while running up lots of revenue in the Netherlands, and so increase their profits in the low tax country. And this process is known as profit shifting. And it essentially involves moving profits to be taxed in lower tax countries. Now, the international community of nations realizes this is a problem. And as you may have seen in the newspapers recently, one measure that has been taken is that a group of developed economies have come to an agreement about implementing a new international regime for corporation tax, which is supposed to be designed to reduce this kind of avoidance among international corporations or multinational corporations. And at the core of this agreement is a new minimum rate of corporation tax. Okay, so what is this minimum rate of corporation tax? Well, the idea here is that the new agreement will reduce incentives for companies to shift their profits from high tax countries to low tax countries by imposing a minimum corporation tax of 15%, and it'll apply to all firms with global revenues of over 750 million euros. And that's a group of around 8,000 companies. Now, that might not seem like very many companies, but in reality, it is these very, very large companies that make the vast majority of global profits and that are responsible for the vast majority of global profit shifting. So this is probably an appropriate group of companies to be targeting. Of course, the crucial question is, will this work? Well, the first thing to say is that there are some very important carve-outs in this agreement, one of which is known as the substance-based carve-out. And this basically means that if you have lots of workers or lots of physical buildings or machinery in a particular country, you're actually allowed to pay less than the 15% minimum corporation tax in that country. So the problem here, of course, is that we may create a new incentive for companies, for multinational companies, to shift their profits to the countries where they have most of their workers and physical assets based. So we might end up just shifting you might just have changing the pattern of profit shifting rather than reducing the amount of profit shifting overall. The second big worry that we might have over this proposal is that we might worry that profit shifting is non-linear. What do I mean by that? Well, let's imagine that we have an economy with a corporation tax rate of 25% and a tax haven where the corporation tax rate is 0%. Well, on the horizontal axis here, we've got the difference between those two rates, obviously 25, because 25 takes 0 is 25. And with that difference between the tax rate in the country of interest and the tax haven, there's going to be a given amount of profit shifting. Now, let's say we introduce a 15% minimum corporation tax rate. Well, the difference now between the tax haven, which has to have a 15% corporation tax, and our country of interest is going to shrink. It's now going to be 25 take 15. The gap is going to be 10 percentage points. Now, we might imagine that if the amount of profit shifting is a linear function of this differential, that might reduce the amount of profit shifting quite a lot. And indeed, that's the assumption that the OECD has made in producing its main costings for this agreement. And for the amount of profit shifting that it thinks this agreement is going to reduce. The problem is there are good reasons to believe that the amount of profit shifting may actually be a non-linear function of the tax gap between, let's say, our 25% corporation tax country and our 15% tax haven. And we can imagine why that might be, because there may be a certain fixed cost to engaging in profit shifting. Maybe you have to pay some fancy lawyers, maybe you take a certain amount of reputational damage, but once those costs have been taken into account, as long as it's still worth it for you to move your profits to the lower tax jurisdiction, you're going to do it whether you're saving 25% of your, whether you're saving 25% corporation tax or whether you're saving just 10%. So if this is the case, we could imagine that even if the gap between high tax countries and low tax countries is reduced quite a lot, as it could be by this minimum tax proposal, it might only reduce profit shifting by a small amount. Okay, so I just want to come to a few brief conclusions now. So what we've seen is that there are reasons why corporation taxes can be desirable. So I don't want you to come away with the idea that corporation taxes are completely useless. As we saw, if there are location-specific profits that are tied to a particular physical attribute of a country, then a corporation tax may be a good option for taxing profits associated with that company, particularly profits that might otherwise flow to overseas shareholders. But as the global economy becomes more and more globalized and as capital becomes more and more internationally mobile, what we've seen is that more and more of the burden of these taxes, of these corporation taxes, is going to end up being pushed onto workers. And that's going to make these taxes less progressive. It's going to push more of the burden of tax onto people with lower incomes. And it's also going to make the taxes less efficient, because the way in which it reduces wages is by basically making the economy that's been taxed less productive, as we saw. And secondly, as investment becomes more and more internationally mobile, as the importance of things like intangible assets increases, and assets like intellectual property have become much, much more important in the global economy over the last 30 or 40 years, this principle of taxation at source, which governs taxing multinational corporations, is becoming less and less coherent and more nonsensical. And that's leading to these quite serious failures in our ability to effectively tax the profits of multinationals. And while there are reasons to believe that, and there are reasons to believe that the actions taken with the minimum tax rate, while well-intentioned, may well not solve the problem of multinational corporate tax avoidance. Okay, so that's all from me. I'll hand back to Heidi now, and maybe I can take some questions if there are any.
Thank you very much, Isaac, for a really interesting talk. And we do have a few great questions on Slido as well. I think we can start with kind of a specific question on one of the slides that you showed us. So you showed us how the amount that the corporation tax in the UK raises as a percentage of GDP is quite cyclical, but it hasn't actually changed much over time, despite these really large changes in corporation tax rate. So the question was, might the tax sort of the fact that it's constant at 2.5% of GDP since the 70s, despite the large cut in the rate. Might that also reflect a large proportionate increase in the total value of private corporations as a share of the national economy?
Yeah, so let me just go back to that slide just so everyone can see it, 'cause it's a great question. So here, yeah, here's the slide on corporate tax receipts as a percentage of GDP over time. Now, it is certainly true that that profits, taxable profits, have increased as a share of GDP over this period. It's not just the fact that, as I said during the lecture, that investment allowances have become less generous over this period. It is also the case that profits have increased, and we might argue that some of that increase of profits may be as a result of the reduced corporation tax. It's certainly the case that we might expect that as the corporation tax rate goes down, there may be more investment, and it may lead to more profit. Another point, just to sort of draw people's attention to, of course, is that prior to the 1980s, there were large amounts of economic activity that took place in state-owned corporations, and many of those during the 1980s were privatized and so moved into the private sector and moved into the corporate tax base. So that's also had an effect. Yeah, so it's a great question, and it is definitely worth bearing in mind that there have been trends in the total amount of profit in the economy over this period. Although it is also worth noting that a lot of economies internationally have seen, particularly over the last 30 or 40 years, the share of the proceeds of the economy going to capital as opposed to labor increasing, so a higher capital share and a lower capital share and a lower labor share. That actually hasn't happened to the same extent in the UK. We've actually seen much more stability in the capital and labor shares in the UK than we have in many other economies.
All right, thank you. It's kind of related to this. You talked about how the corporate tax rate has changed quite a lot in the UK over time, and we've seen this decline over time. But we now know that the plan is that corporation tax is expected to rise from the current sort of 19% to 25% next year. So do you think that kind of increase will then have an impact on investment in the UK, or do you think it might actually reduce investment in the UK?
Yeah, so it's a great question. It's absolutely the case that we now, despite a bit of back and forth as a result of the mini budget recently, we are now back on for having the first corporation tax rise in more than 50 years. Is going to take place in April of next year. The corporation tax rate is set to rise from 19% to 25%. Whether it will affect investment is actually a slightly more complicated question than it might initially seem. You might think, well, if the rate goes up, surely that deters investment, just as we talked about in the lecture. But it isn't only the rate that matters. It's also very important to bear in mind the base when we're thinking about corporation taxes. And there has been some increase to the generosity of investment allowances that's going to take place when we increase the corporation tax rate. And from previous noises the former Chancellor and now Prime Minister Rishi Sunak has made about capital allowances and investment allowances, there may be more of those in the future, we don't know. But it is possible to increase the rate while not necessarily disincentivizing investments, particularly domestically, by having capital allowances or having investment allowances that allow firms to deduct investment spending from their profits, and so ensuring that investments remain viable even in the presence of tax. Nevertheless, it is the case that a higher rate is going to be particularly important for international firms that have highly profitable projects which they're thinking about where they want to locate them. So if I'm a big multinational company and I have I don't know, a factory that I know is going to be very profitable, and I'm thinking about which country to place that in, capital allowances tend to be less important for me than the headline rate corporation tax. So as the headline rate of corporation tax goes up, it's particularly the location, those location decisions on an international basis that we might expect to be affected by having a less internationally competitive corporation tax rate in the UK.
Very interesting, thank you. Another really interesting sort of question when it comes to some of the challenges of taxing multinationals is, of course, when you're thinking about not just goods, but thinking about tech companies that operate internationally. There's a question, a very specific question on this. You know, you can obviously answer more generally on what some of those challenges might be for tech companies, but there's also a specific question on whether you have any thoughts on how the growing importance of virtual worlds and assets for sort of the metaverse might complicate the analysis of value creation.
No, great. Yeah, no, that's I think that's definitely the first taxation of the metaverse question I've had, but always good to hear those. So I actually didn't have time to properly get into some of the very, very interesting questions that surround taxing tech companies in particular, and it is a really interesting issue. So one of the features of the international tax system that we didn't really talk about in this lecture is something known as the permanent establishment rule. So you're only liable to pay tax, to pay corporation tax, that is, in a country, if you have what's known as a permanent establishment in that country. And because these rules were basically formulated when, to operate in a country, you probably had to have a decent physical presence there, a lot of the rules and a lot of the legal precedents that determine whether a company has a permanent establishment in a country don't apply very well to tech companies. So, for instance, if my only presence in a country is delivery infrastructure, so for instance, if I'm Amazon and all I do in a country is undertake deliveries there, but maybe my fulfillment center or where I take the orders is in a different country, then I'm not liable to pay tax necessarily in that country, or to pay corporation tax in that country. And so you could see that, you know, and similar problems arise with companies like Facebook, where their users may be based in one country, but their headquarters and their permanent establishment were based in another country. And the current, as things currently are, the country where the customers are based doesn't necessarily have any right to tax the profits of that corporation. So that's led some people, it's led some countries to implement so-called digital service taxes. We have one in the UK, and there's a number of other European countries that have brought them in to try and get at some of these profits by taxing the revenue that these companies are making in their jurisdictions. And there have been other proposals to come up with international agreements where some share of multinational profits are distributed to countries on the basis of where customers are, rather than just where these permanent establishments are. And that is part of the same package of proposals that has the minimum corporation tax rate in it. Although it's worth saying that at the moment it's not a very large share of these multinationals' profits that are being proposed to be redistributed on the basis of where customers are. So yeah, I think this is still a big challenge that the international community hasn't really found a good solution to. These kinds of companies that can have their users and their customers all over the world, but have just one office or one permanent establishment in just one country, and they can choose that country on the basis of its corporation tax rate.
Okay, thank you. There's a question on the incidence of corporation tax, and in particular, the question asks if the incidence of corporation tax might also fall upon customers and other suppliers, particularly if demand for supplies is constrained and alternative products are not available to customers.
Yeah, so that is definitely something that can happen, and it's definitely something we should take seriously. The reason you wouldn't get it in the sort of very simple models I was talking about is that those are models where firms are price takers, and you have well-functioning competition. There are definitely cases where imperfect competition. You'd expect it to be possible for firms, maybe if they're in a monopolistic or an oligopolistic situation, they might be able to increase prices for their customers and to push some of the burden of tax onto customers. So yeah, that's definitely something that that we should take seriously, and definitely something that previous studies have found. In fact, they found that in certain circumstances, increased corporation tax has led firms to increase their prices.
Okay. Then on the minimum tax rate, so you sort of mentioned that there are some potential issues. So there's a question on that, whether the OECD will regularly review the effectiveness of the minimum tax rate and increase the minimum tax rate if the evidence points to non-linearity. And sort of more generally speaking as well, if you think that there are these issues with the minimum tax rate, do you see that there could be sort of a better solution to this question?
So I think the I'm sure this is the non-linearity problem, and some of the issues with the carve-outs are not problems that the OECD is unaware of. They're perfectly aware that these could be issues. Of course, the problem that you always have with these things is that it is not easy to broker large international agreements between many different countries, and so yes, in principle, of course, the OECD could increase this rate further in the future, could make further changes to this agreement, but it's not always easy to do that. You do have to get a lot of consensus from a lot of different economic players, and doing that can be difficult. So I think you do need to be a little bit careful in assuming that this stuff is all just going to be worked out nice and smoothly by the international community. In terms of whether there are better proposals out there, there are other proposals out there, particularly in the academic literature. So one proposal that I think is an interesting one is the idea of what's known as a destination-based cash flow tax. So the basic idea there is that, as we've seen, a lot of the problems with corporation taxes in this international environment occur because capital is very, very mobile, and labor is not very mobile. And in general, trying to tax something that is highly mobile can be quite a bad idea, because it leads to bigger distortions, it leads to inefficiencies. And so the idea of the destination-based cash flow tax is that you would tax companies based on their sales. So it work a lot more like a VAT, basically, except they're allowed to deduct their labor costs. And the idea being that the location of a firm's customers is much less mobile than the notional location of its profits under the taxation at source system. And so I think there are good reasons to think that if you wanted to implement a genuinely sort of transformative reform, that that might be an interesting option where you would seek to target the location of the customer as opposed to the location of the value add.
Right, and that was actually sort of one of the questions as well here, whether there was an argument against charging corporation tax according to share of sales made in a country, but it sounds like you think that's has been proposed as one of the solutions to the issue. Just before I finish off, there is one comment saying this presentation rather ignores some of the major changes in corporation tax in the EU and the UK in response to the BEPS inclusive framework actions. These changes broadly ensure that profits and tax follow people-based activities. I don't know if you have any comments on that. That specific.
Yeah, I mean, these features are, it's certainly true. I didn't go into those, but mainly because they're extremely complicated, and I didn't have time to sort of go into the details of all of them. And there have been some good changes. For instance, it's harder than it used to be to shift profit internationally through things like the use of loans and the use of interest payments. So there has been progress on that front in the UK, but it is still the case that multinational corporations do find it, don't find it impossible to shift their profits to lower tax jurisdictions. Now, I do think some progress has been made on this front, but fundamentally, the approach that's been taken has been to sort of patch up some of the holes and to do it generally imperfectly, and avoidance in many of the same ways.
Okay, well, thanks very much, Isaac. I think that's it exactly at 2 o'clock. So we'll bring this event to a close. Thanks very much, everyone, for listening, and thank you for the great questions as well, and thank you to Isaac for a great presentation. Thanks very much. Thanks very much.